Chapter 7. Financial Regulation and Bankruptcy. Financial regulation and bankruptcy law form a legal framework designed to maintain financial system stability, protect the interests of creditors and debtors, and ensure the continuity of economic activity. Financial regulation governs transaction mechanisms, banking operations, and payment instruments, while bankruptcy law provides structured procedures for resolving situations in which a business entity is unable to meet its financial obligations. Business law literature emphasizes that a balanced system must protect creditors' rights while also offering restructuring opportunities for debtors. This balance is a fundamental principle of modern financial and insolvency law. A well-functioning financial regulatory framework not only ensures the stability of financial institutions but also promotes public confidence in the financial system. When investors and consumers trust financial institutions, economic transactions can occur more efficiently and economic growth can be sustained. Financial regulation also aims to reduce financial risks that may arise from market failures, excessive speculation, or poor corporate governance. Through proper oversight and supervision, governments attempt to prevent financial crises that could disrupt national or global economic systems. Therefore, regulatory authorities often establish strict rules and monitoring mechanisms for financial institutions. Laws on negotiable instruments. The law on negotiable instruments regulates transferable financial instruments used as payment methods or debt guarantees, such as checks, bills of exchange, promissory notes. These instruments are characterized by their transferability through endorsement or delivery, allowing the lawful holder to demand payment. A key principle in negotiable instruments law is trust and certainty of payment. This principle enables commercial transactions to operate efficiently without requiring repeated verification of the underlying contractual relationship between the original parties. In business practice, regulation of negotiable instruments supports smooth cash flow and strengthens the payment system within commercial activities. Businesses frequently rely on these instruments to facilitate transactions across different regions and industries. By providing legal certainty to holders in due course, negotiable instrument law encourages the circulation of financial instruments in the marketplace and promotes commercial confidence. Banking regulation. Banking regulation aims to safeguard the stability and integrity of the financial system. Banks are subject to strict supervision by financial authorities, including requirements related to minimum capital adequacy, risk management systems, financial reporting transparency, consumer protection. Banking regulation also includes provisions concerning anti-money laundering, or AML, counter-terrorism financing, or CTF, good corporate governance. In business law analysis, banks are considered systemic institutions. Their failure can have widespread economic consequences. Therefore, banking regulation is designed to minimize systemic risk through prudential supervision and early intervention mechanisms. In addition, modern banking regulations often require stress testing and continuous monitoring of financial institutions to assess their resilience in times of economic uncertainty. Regulatory bodies may also impose liquidity requirements and capital buffers to ensure that banks are capable of absorbing potential financial shocks. Insolvency procedures. When a company experiences serious financial distress and is unable to fulfill its debt obligations, bankruptcy law, or insolvency procedures, provides a structured resolution mechanism. The process typically begins with a bankruptcy petition filed by either the debtor or a creditor. This is followed by the appointment of a trustee or administrator to manage the debtor's assets. The primary objective of bankruptcy law is to ensure the fair distribution of assets among creditors according to statutory priority rules. Creditors may include secured creditors, unsecured creditors, employees, and government authorities, each of whom may have different legal priorities in receiving payments. In addition to liquidation, many modern legal systems also provide restructuring or reorganization procedures. These mechanisms allow a financially distressed company to reorganize its debts and continue operating. Successful restructuring can preserve jobs, maintain business relationships, and reduce the negative economic impact of business failure. The importance of an effective insolvency system. An effective insolvency system must ensure legal certainty, transparency, protection of creditors' rights, opportunities for debtor rehabilitation. Efficient procedures reduce the economic costs of business failure and contribute to broader economic recovery. Conversely, prolonged or uncertain insolvency processes can undermine investor confidence and negatively affect market stability. Furthermore, an effective insolvency framework helps create a predictable business environment where investors feel secure in providing capital. When creditors trust that legal mechanisms exist to recover debts in cases of default, they are more willing to finance business activities.
Okay, see you on the top.
Yes.